Hi, everyone. This is Arash Adnani with privateplacements.com. A very special guest with us today and a very timely guest on the topic we're going to cover. We have Scott Melbye, CEO of Uranium Royalty Corp, ticker symbol URC. URC was the largest mining IPO on the TSX and TSX Venture last year in 2019. It was a $30 million IPO. It is the only uranium-focused royalty company out there right now, and the first one. But Scott, other than the success with URC, you're one of the top minds and thought leaders on the uranium market. You've had over 35 years of experience. You've spent time with Cameco, the largest uranium producer, all the way to Uranium One, UEC, and now URC, still obviously with UEC as well. Last week, there was some significant news. Cigar Lake, Cameco's uranium mine, they announced that they will be shutting down for 4 weeks. It may be longer, we don't know. Uranium has had a bit of rally since then. Can you speak to the importance and the significance of this news? And really, maybe for our audience members who aren't too familiar with the uranium markets, you can give us a bit of an overview of just Cameco, Cigar Lake, and how it all ties into what's happening right now.
Sure. Well, thank you, Arash, and it's great to be with your audience today. You're right. The announced shutdown of Cigar Lake in northern Saskatchewan last week has had a significant impact on the market. It is a mine that represents 12 to 13% of global production. In an industry that is highly concentrated, we are reliant for a great deal of uranium globally from a small handful of very large mines. So anytime you have a disruption or a shutdown like that, it's going to have an impact. But it's perhaps more meaningful to put this into perspective, because this shutdown last week with Cigar Lake was driven by COVID-19 coronavirus concerns about the workforce, fly-in camps in northern Saskatchewan, rural communities, and Orano and Cameco, the owners, were concerned about the welfare of their employees and made the decision to shut in. Now, I think there also may be some economic element there as well, because as you know, Cameco Corporation shut down the McArthur River mine in Saskatchewan for economic reasons, to help rebalance the uranium market fundamentals by shutting in production and buying to fill their contracts. So maybe a little element of both, but it was really driven by the COVID-19 pandemic that we're all living through. But it comes on the heels of really tightening fundamentals that we've seen really develop over the last few years. Uranium has gone through probably the deepest and longest bear cycle of any commodity in recent times, really seeing uranium prices in the $70 a pound range as recent as 2010, but falling all the way to $17 a pound, well below any sort of production cost levels of global producers in 2016. So while we've been in a long bear market, I really peg 2017 as the first year of the recovery of the fundamentals, not necessarily the price moving that much, but that's when producers started cutting back production to address the oversupply. And it's important to note that uranium is not the most efficient commodity like copper or gold, where price signals immediately signal increased production or decreased production. It takes a long time to bring mines into production because of the nature of uranium. It also takes a long time to take production off because of the hedged nature of the uranium market. So even though prices were falling, year over year, production was increasing and peaked out in 2016. But since that time, we've seen almost 50 million pounds per year of supply taken out of the market. That was even before we got into this coronavirus period. But what's significant now is that mines, not just in Saskatchewan, but around the world, are facing the same kind of challenges. We have our eyes very closely on other regions. We've seen Namibia, which is one of the largest uranium producing countries in the world in southern Africa, shut in all their uranium mines last week. Mines in South Australia and Northern Territories of Australia, we have our eyes on whether there'll be developments there. And certainly Kazakhstan, which now produces 59 million pounds out of the 140 million pounds produced globally. Any disruption to those mines in Kazakhstan could have a real impact on supply and demand. And even if it is temporary, any sort of shutdown, whether it's a month, 2 months, or 6 months, really helps rebalance a market that was already getting to a tipping point going into 2020.
So, Scott, you mentioned some of the other largest suppliers. So just to provide some perspective here, Kazakhstan, for example, kind of has the nickname as the Saudi for uranium as far as a producer.
Yeah.
Can you tell us like how much of the market between Namibia and Australia and Saudi are we talking about?
Well, the Kazakhs are 59 million pounds out of 140 million globally. Big mines in Australia. Olympic Dam has been a several million pound per year producer for many, many years. It's a multi-mineral operation, copper, gold, and uranium. What's significant there is a lot of their production tends to hit the spot market rather than going to the long-term market. So any reduction in their supplies has, I think, an immediate impact on the market. The Beverly 4 Mile mine in South Australia is not as big. It's an ISR operation, but still puts in 2-3 million pounds a year into the spot market every year. So these do have a significant impact, and it really is, as I said, is coming as we're in an inflection point in the uranium market. We spoke to the demand cutbacks or the supply cutbacks, but we've also seen demand really recover from the early years of the bear market in uranium and 2011, 12, 13, 14. The focus was on Japanese reactors shutting in and the slow restarts, or Germany moving away from nuclear energy. But now, as we're in the last gasp of that bear market, we've seen robust reactor growth around the world. I mean, we've seen 47 reactors constructed in the last 7 years, 54 units under construction. So we're back to a pre-Fukushima level of demand in just the last year or two. That's significant because there's a robust underpinning of uranium demand close to 190 million or 200 million pounds a year in the coming years of demand. So we have supply cutting back dramatically because of the low prices. We have demand strong and growing. One of the next shoes to drop was really the utility procurement, which really utilities globally, they also were coming out of long-term contracts that they signed in previous markets, but they weren't jumping back into the uranium market to sign new contracts. They've been happy to kind of feed off the low spot market prices and carry trade, which is dominated by trading companies. That's a very near-term beneficial activity for them to lower their fuel costs, but at some point they have to shift the sails as the winds are changing and turn more strategic. And that was beginning to happen already in the fourth quarter of last year and has continued into this year. So all of these cutbacks and now coronavirus cutbacks and supply threats are coming at a time just when the next procurement cycle was beginning with global utilities. So we have the makings of kind of a perfect storm, and it's not unlike previous bull markets. The uranium market in 2007, everyone recalls that it went as high as $137 a pound from about $10 a pound in a very short period of time. Was really a similar situation where fundamentals had been adjusting for a number of years, but it took a couple of supply shocks, a fire at a mill, flooding at some mines in Saskatchewan was enough to kind of tip the boat. Now, whether this coronavirus is enough remains to be seen, but we're already seeing strong movement in the uranium price. Literally in the last 2 weeks, we've seen uranium price go up 18% from $24 to close to $28 today. That's pretty significant considering that we're in a period where oil prices have gone from $60 a barrel to $20 in the last 54 weeks. So uranium is probably one of the strongest commodities of any investments, frankly, going up in a period of financial instability. It's been a real contrarian move in uranium.
Can you explain, so on the supply demand side, let's say there's more shutdowns of the mines, right? Which is, highly likable because with everything that's going on with coronavirus, it doesn't look like it's going to slow down anytime soon, right? So we're in a bit of a holding pattern.
Yes.
So we can see more shutdowns happening. We can see more news coming out in the near future. Once that happens, can you almost provide a step-by-step on how that affects utilities who are in the market to buy uranium, and maybe explaining that the fuel buying cycle a little bit?
Sure.
It's a little bit different than other commodities.
Yeah, well, one, the procurement cycle, uranium is consumed on a very steady basis. Nuclear power plants are 24/7 baseload power supplies. So the consumption of uranium is steady state, but the procurement can vary on market perceptions, contracting, a number of different factors. And so we had just gone through a period of several years where utilities had procured less than normal levels in the long-term market. Again, choosing to be more short-term oriented. As that changes, that's going to put more pressure on supplies. Well, what's been happening is with the production cutbacks and demand being strong, we have a gap now of 40, 50 million pounds per year. That gap's being made up by inventories and secondary supplies. So what
are the secondary supplies?
Well, inventories are a good example, which would be government inventories, excess inventories, producer inventories, utility inventories, but also uranium, which is coming from the enrichment process in the form of underfeeding. But it's the gap that's being made between production and consumption. And uranium's unusual in that for my entire career, we've seen uranium consumption be higher than production for the last 30 years. Well, that's significant because you're drawing down inventories, and at some point the inventories are drawn down completely. And that's what we're seeing now, that this drawdown is occurring and accelerating at a period when new contract cycle begins and the supplies are just not there. And the time frame to bring on new mines, when I was at Cameco, we brought on McArthur River in Saskatchewan in 10 years. That was a huge success and undertaking, but it just shows you how long it takes to bring on a mine in the uranium business, much longer than copper or gold. So, the utilities are in a very precarious situation now where, one, they're relying more and more on supplies from, say, state-owned entities in Kazakhstan and Russia, which, that in itself has certain geopolitical supply risks. But if you have risks to mine supply from coronavirus or even just normal mine disruptions, the utilities are very vulnerable because the level of inventories that everyone has really had that cushion, that comfort level is rapidly depleting. And we're into a period where not only new procurement is occurring, but new production is needed. And we're well within the lead times to bring on those new mines. So, as developers, whether it's UEC positioning its ISR assets in Texas or Wyoming to be one of the early movers there, or your Uranium Royalty Corp, where you're a source of finance for mine development, we're really looking at those companies that can be the early movers that have permitted licensed mines or have mines in standby that can be the first beneficiaries from this market cycle. Because if you have to start from scratch today, permit, license, and construct, it could be a 6, 7, 10-year process for new mines.
Do you guys have an idea for inventory for the different utilities out there and when they need to go out there to purchase more?
Yeah, and inventory levels really vary. One thing that we have seen is utilities have been reluctant to sign new contracts, or if they have contracted, it's been very short term, or some utilities have just been content to draw on their existing inventories rather than contracts. So that's a reflection that they haven't been as concerned about future supplies, and they're comfortable in drawing down. And it may be just an economic imperative to draw down inventories. There's some reactors in the U.S. that were under the deregulated market pressures, the threat of shutting down early before their licensed life. Well, we found that the base load nature of nuclear and the clean air aspects of nuclear are now being valued in the energy mix in the United States, and plants that could have shut down early 5 years ago are now getting a new lease on life and are going through life extension and operating for the next 30 years. So they may have said, oh boy, we were drawing down inventories. Now we've got to, reverse course and start contracting again. Global inventories, that's the most opaque figure to try to pin down. But I mean, the best figure that I've seen is, about 5 years ago, we at UEC and URC, we pegged that level at about 350 million would be true excess material, which could hit the uranium market and be liquid to the uranium market. Now, you've heard higher numbers of global total inventories in all forms, but inventory that's in the hands of the Chinese government for their own needs, or is in pipeline process that's going into reactors and fabricated fuel, is really irrelevant to market analysts. It's what material can hit the market. So if that was 5-6 years ago, 350 million pounds, and we've been drawing down now 40 to 50 million pounds of excess supplies in this rebalancing, we're getting to a period where, we're now out of the excess supplies, and suddenly the inventories turn strategic in nature. And that's when you get a run on uranium supplies like we saw in the 2005 to 2007 period. So we're seeing a lot of the similar conditions. I'm not predicting we go to $137 per pound, but it's not impossible. And when these things set off, I mean, already we've seen the uranium price go up $4 a pound in 2 weeks. So when it does start to move, we can see pretty dramatic. That's the positive side of our inefficient uranium market, is that it's quite a headwind when you're an oversupplied market. But when we go to undersupply, that inefficiency really is part of the investment narrative. And you can see some real outsized gains because the uranium market doesn't react as efficiently as it would in other commodities. It can overshoot and go much higher than would be rational from an economic perspective.
So if we were to get to, so pre-Fukushima, it was $70 a pound, right?
Mm-hmm.
We're sitting at just under $28 a pound right now. I think everyone would be happy with $40 a pound at this point. What if, in your opinion, as far as catalysts that can get us to 40 or let's say in the 30 range, there's the mine shutdowns. What else is at play? I know there was a lot of talk in the US with the White House talking about prioritizing domestic production more, and now that's becoming more and more important with everything that's going on, right? Can you give us some other catalysts that could be at play?
Sure.
And in the move of the uranium spot price?
Yeah. Well, and maybe clarify, I mean, I think when you say, $40 market, would be great. I think the $40 to $50 range would be the incentive price for the world's best mines. So that would be very low cost ISR, scalable ISR, or the mines in Saskatchewan. Cameco has said that they will restart mines in the $45, $50 range. But most mine production globally, especially if it needs big capital investment, maybe as much as hundreds of millions or $1 billion to develop a very large conventional mine, you need $65, $70 to make that decision. So we still have quite a ways to go. But the catalysts, as we said, have been both on the supply side, the demand side, procurement cycles, and some black swan events like COVID-19 that are really contributing to this. But you mentioned one driver in the United States. I think those in Canada, around the world, are quite familiar with the Section 232 process as it impacted steel and aluminum imports from abroad into the United States. It was determined then that the import levels of steel and aluminum were a threat to national security. A similar filing was investigated in the United States, and the result of those findings is that the Trump administration decided against tariffs and quotas in the case of uranium, but felt very strongly that there is a national security element here. I mean, we get 20% of our electricity from nuclear. It's 60% of our carbon-free electricity, and we're relying almost 100% on the fuel supplies for 20% of our electricity from abroad. That's of cause enough, but we also have the added impact of the US nuclear Navy, which has another 108 reactors and 80 some submarines and aircraft carriers that must run on US origin uranium. So while the uranium market was enjoying very low supplies and not as worried about state-owned entities in Russia and Kazakhstan, we kind of got lulled into complacency. That's one thing for the utilities, where it's a business decision and they'll have to face their own risks of that. For the defense needs, we have to have a domestic fuel cycle of uranium conversion and enrichment to be able to support our own needs. We can't rely on other countries for our defense needs. So the Trump administration moved forward with the Nuclear Fuel Working Group, which is a task force of all of his cabinet secretaries and various agencies in the administration, to come up with policies that will revitalize the uranium industry and get us back up and running and be able to be a viable industry again. We were set to hear the results of that policy work and recommendations when first we were impacted by the events in Iran and the Persian Gulf, kind of put off the release of the report in dealing with that. I think everybody forgets we were on the verge of World War III not that long ago, but that kind of put it off in the first instance. And then unfortunately with the COVID-19, the report sits on Larry Kudlow's desk in the White House. However, it's understandable that the president and the administration has higher priorities right now with addressing the health crisis with the COVID-19. The good news is this COVID-19 experience for the United States really showed us how vulnerable we are to critical supplies. And in that case, it's masks, gloves, pharmaceuticals that we're getting from China. But on the mineral and energy side, we've really seen now critical minerals, rare earth minerals, the control of those supplies really taken away from us by China. We've seen oil and gas impacted by price wars between Saudis and Russians, and uranium production impacted by state-owned entities in Russia and Kazakhstan. So it is possible that we are being discussed in the same conversation as those other critical industries that could be wrapped into upcoming stimulus legislation or energy policy, or all of the above, that addresses not just uranium but other oil and gas. It's interesting to note that the Secretary of State last week gave a presentation and referenced our vulnerability in the nuclear fuel cycle, specifically with uranium. So
I saw that. I thought that was pretty interesting. With everything.
Yeah, so we're really optimistic, confident that the administration's taking it seriously. Obviously, they have a lot of fires to fight with the pandemic and addressing it, but we're confident that the administration realizes it's a priority. As an industry, we're working to ensure that it moves forward, it's announced, and it gets funded by Congress or through the defense appropriations, whatever it takes to get this going. We think it'll be a real boost. So for producers in the United States, I think they're already going to benefit from this rebalancing uranium market globally, but could get an added kickstart by the Trump administration when this policy moves forward. The most tangible element that we have seen is the establishment of a national uranium reserve, where $150 million per year would be spent on domestic mine purchases as a way to kind of build up our stocks of domestic uranium. So that's a great first start, but we understand there's more to the policy, according to the Energy Secretary. So we're eager to see what else is in the policy.
So Scott, you're like we mentioned earlier, you're one of the top guys in uranium mining. You've schooled me on many occasions about the importance of nuclear energy and just the uranium industry and the mining industry of it. Can you, for our audience members that aren't as well versed in nuclear energy, and I want to keep this short because I want to quickly pivot to URC after this. Mm-hmm. And you can give us, maybe narrow it down to 3 points, okay, about why nuclear energy, why now, and why we really need it as part of the energy solution.
Sure. Well, I think those of us in the industry have always recognized the benefits of nuclear energy being large baseload power, affordable power. The fuel costs are a minimal percentage of the generating costs, but to be able to produce carbon-free electricity and pollution-free electricity. We've always recognized that, but it's getting the broader environmental community or climate change community to really accept us as part of the solution. And that's really changed in the last 2 years, 3 years. We just passed COP25 in Madrid, where there's almost been a panicked realization that they've been doing this for 25 years and have really achieved nothing in terms of carbon reductions globally. Even countries like Germany that spent hundreds of billions of euros on renewables, but turned away from nuclear at the same time and have achieved very little in carbon reduction and have managed to achieve some of the highest electricity prices in Europe, something that's very critical for their manufacturing export economy. So we're now being accepted as part of the solution. Former opponents are now proponents, or at least dropping opposition to nuclear. And that's really translating into this reactor growth. So we're quite optimistic. We also have the small modular reactors, which are not the 1,600 megawatt huge reactors. They're the 1,500 megawatt reactors, which are being deployed in China, the UK, the United States, Canada. We're seeing great promise in that. So again, it's nice to be accepted more broadly. Something we've known for many years, but we are.
With Bill Gates and the investments that he made, was that with the micro reactors, or is that something totally?
Yeah, that's Bill Gates has an advanced reactor that kind of fits in that SMR and advanced reactor category. And, he's a great example where, some of the big tech giants, Peter Thiel, Bill Gates, others, they're smart enough to do the math and the science. And they're going, okay, we're not anti-renewables. We love renewables, but there's limitations. You can't have something that runs 25% of the time be 100% of your energy supplies. And so, they've taken it a step further. Bill Gates has actually gone out and invested in, innovative reactor designs that can be part of this solution going forward, because they realize our economies are being more and more electrified, not less. Everything's computer generated. Cars are eventually going to be all electric powered at the rate we're going. And we need clean energy to back up all those clean electric vehicles and other applications. So yeah, it's all very encouraging. They're opinion leaders that people listen to. And so again, it's part of the changing narrative.
What are your thoughts on the Tesla Cybertruck?
Well, I mean, listen, whether it's Tesla or it's BMW or Toyota or anyone else, I just think that that's where the trend is moving. And, it's great to talk about that, but that's going to require a lot of copper, lithium, and a lot of other sort of battery and metals. But we also have to remember that if we're just all driving electric cars that are powered by coal or gas, we're not really achieving the carbon emissions. And certainly in the trucking industry or even smaller vehicles, it's certainly something that's exciting.
Well, you avoided answering the question. This is a very polarizing topic. You like the Cybertruck design? Are you a yes or a no?
Well, I think it's kind of cool. It's very Mad Max for these times. So when you pull that into the supermarket parking lot, that's you make a statement.
That's the vibe you're going for, is Mad Max. Okay, so we talked about URC, Uranium Royalties Corp, the largest mining IPO in Canada last year, $30 million IPO. The only and the first uranium-focused royalty company out there. Tell us what made you guys kind of decide that the market needs this, and maybe just give us a quick background on how royalty works and why it's so great for the current climate.
So, it was really a realization. The company was founded privately a little over 3 years ago, taken public in December of last year. But there was really a realization of the co-founders of Uranium Royalty that an enormous industry over the last 10 to 15 years has emerged in base and precious metals. These are companies like Wheaton Precious, Franco-Nevada, Sandstorm, Royal Gold. They've provided an incredibly attractive investment vehicle for investors that want pure play exposure to a commodity, but want diversified risk. It's also provided an incredibly attractive alternative finance for new mine development. And, if you're developing a mine in any industry, your main options are debt or equity. Both have pros and cons to them. But in some markets, like with uranium today, it's very difficult at the bottom of a 9-year, 10-year cycle to go out and raise equity at the bottom of the cycle. Or, the debt window may, even with low interest rates, the debt window may be closed for riskier investments like uranium mine development. So when we come along with a royalty and streaming alternative, it really is an appealing source of finance for mine developers. And as I said, we're doing our due diligence out there, and we're working with all the potential mine developers, miners, various stages, to really determine, okay, out of the universe, who are the companies that have the assets, the management teams, permitting, licensing, and political risk to move forward and be the mines that will be supplying this shortfall, which we think is, we're already technically in a shortfall today with the mine cutbacks. We think it's only going to accelerate in the coming 5 years. So we want to be the company that backs and finances through royalty and streams their development into production. And for investors, it's an incredibly great way to have exposure in all the various uranium producing regions, ISR mines, conventional mines, various stages of development. So, we really are emulating a proven, tried and true model in base and precious metals, and we're bringing it to uranium.
It's a great way for someone to gain exposure to the uranium market if they're just entering the uranium market and wanting to, I guess, get started in it.
Absolutely. I mean, you can benefit from, we're a company of people. There's 3 of us in the management and board team are former executives with Cameco in the mining, the geology, marketing, and sales. We get the business, we get the opportunities, and we also understand the risks. And so when we go through and we do our due diligence, every mine developer believes their baby's the most beautiful baby they've ever seen. And we may agree, yes, your baby's beautiful, but hey, we've permitted and licensed mines in Saskatchewan or in the United States or elsewhere. And, so we're very conservative, and we really scrub the assumptions, and we place capital where we think it's best deserved and has the best chance of returning, in our case, in the form of physical streams of uranium or royalties. And so when investors invest in our company, they're benefiting from our 35 years each experience in uranium mining, marketing, sales, and nuclear energy, to be able to know that they're getting a diversified investment that has gone through a great deal of due diligence.
And so, Scott, do you guys have exposure to actual physical uranium through any of the investments?
Yeah, so one of the first investments that Uranium Royalty made was a foundational investment in Yellowcake PLC out of London. We were part of their IPO process as one of the cornerstone shareholders. We liked that, one, because of the timing.
Right.
Our investment in Yellowcake effectively gave us exposure to $20 uranium that they acquired through their very long-term $1 billion supply arrangement with Kazatomprom in Kazakhstan. But beyond that, it also gives us strategic relationship with Yellowcake to work with them if they identify royalties and streams. We can work with them to access those. We can also work with them to access physical uranium. We have the right to buy $31 million US worth of uranium from Kazatomprom through their supply arrangement. So it's something we're quite excited about. We're never going to go too much down the physical uranium side, but for a new royalty and streaming company that is not yet steady state, where we see a steady state of royalties and streams coming in today, it's a way to reward early shareholders and lever them to this really historic low point in the uranium market and participate in capital appreciation of the uranium that we hold through Yellowcake in the near term, and until we get to a point where they're benefiting from the cash flowing streams.
Well, it's a really exciting story on a proven business model, like you said. Scott, thanks so much for joining me and making the time. Very educational and very exciting as always. Again, we had Scott Melbye, CEO of Uranium Royalty Corp. Please like, subscribe, and comment below. Until next time, thank you.
Thank you.